Hi, everybody. It looks like it's 1 o'clock, so we are going to get started. People are still coming into uh, the webinar, but we will begin now. And I just wanted to take a second to introduce Will Simons, RS from Association Reserves, and thank him for allowing us to have him present this very informative webinar today. So thank you very much, and take it away, Will.
Okay, well, hello everybody. Thank you for joining us today. For those that don't know me, my name is Will Simons. It's a pleasure to be with you virtually. I just got to say, I miss you guys. I know there's a lot of people that are involved with the chapter that I haven't seen now in, I guess, over a year. So it's kind of strange, kind of uncomfortable, unusual to be doing all this stuff on Zoom, but I guess that's the new normal. So yeah, I just want to say thanks to Jill and everyone at the chapter for putting this on. Always great to work with you guys. Thanks again for the opportunity. Some of you may remember that I actually taught a class last June for the chapter, which was called Reserve Study Roadmap for Managers. But actually within the last year, we took a lot of the material from that class and repackaged it into this new one, which is called Reserve Funding Methodologies. We had to make some of those changes based on new developments within the industry. So basically at a certain point, it just felt like it made more sense to kind of come up with an entirely new class. So it does have a new course number with the state. You will get credit for this in addition to that roadmap one if you took that before. So yeah, don't worry if some of this material feels familiar. Some of you may have seen it before. You're not going crazy. But there are some new concepts that we're going to teach today, especially at the very end. And I'm especially interested to get feedback from the accountants in the chapter because some of what I'm going to cover is based on some of the stuff that's maybe more in your purview related to audits and things like that, and based in large part on some of the conversations that we've had over the years. So I'll be interested to hear what you guys think. Class itself should run just under an hour, and then we'll have time for Q&A. So as the class goes on, feel free to submit any questions you have using the Q&A button there on the Zoom taskbar. I'll try to stay on as long as I can at the end of the class. I figure at least 20, 30 minutes or until we run out of questions. So, Jill's going to be kind of monitoring that as we go along. She'll kind of screen out any questions that may otherwise be covered, but feel free to submit those as we go. I'll turn off my camera during the class itself just so everyone can focus on the slides. Yeah, just a couple of housekeeping reminders. We are recording the class today, so we'll be sending out a follow-up email to all the attendees once that's available. I'll also email out copies of all the course slides, so don't feel like you need to ask for those. Everyone's going to get those by default. And then feel free to share any of that information with people as much as you like. This is all, for the public good. So if you have board members, if you have colleagues that couldn't attend today for whatever reason and might find it useful, feel free to share the slides with them. If you work with a management company, I do these types of presentations all the time for management companies directly. So reach out to me if you might be interested in that. For all the CAMs in the audience, we will be submitting all the credits to the DBPR as soon as possible. Should be within the next week. So if you have any questions on that, or if you don't see your credit posted, please let me know. We'll also be sending out the course completion certificates by email as well. So without further ado, I'm going to turn off my camera. We'll start the course and we'll get started. So thanks everybody again, and here we go. Okay, so again, this course is called Reserve Funding Methodologies. It is approved for 1 hour of continuing education credit as either a insurance and financial management course or as an elective. I think we've already covered it, but if you haven't already provided us with your first name, last name, and CAM license number, please be sure to do so. You can email that to me or to Jill directly if you didn't do that as part of the registration process, because otherwise we won't be able to get you any credit for the class today. I don't want to give the impression that this course is only for managers. Any board members, any industry reps, anybody who has a vested interest in the subject matter here is definitely going to learn a lot and come away better prepared to lead and serve your communities. So let's get into it. Before I do this, I'm just going to take a quick moment to introduce myself and our company in a little more detail. Again, my name is Will Simons. I'm the president of the Florida office for Association Reserves. I've been with the company now since 2008. The RS after my name stands for Reserve Specialist, which is an industry-specific credential that's only awarded to people who have essentially demonstrated their expertise and experience in preparing reserve studies. That designation does come from CAI, which obviously we're all familiar with. As of right now, I'm proud to say we've just minted our 2 newest reserve specialists on our Florida team. That brings us up to a total of 5 reserve specialists in Florida. But nationally, we've got several dozen. I believe we have the most credentialed reserve specialists of any provider in the US. Personally, I've lived in both condos and HOAs. I was the treasurer and vice president for about 6 years of my own HOA in South Florida. I had a budget there of over $1 million, 635 homeowners. The reason I point that out is because I always just want to remind people that I do know what it's like to be on the other side of the table, right? Working with volunteers, working with committee members who are responsible for managing the associations there. So I know what goes into that, and I admire all the volunteers who do that, and the managers that help work with them as well. So our company is basically the oldest and largest reserve study provider in the US. We've been doing this since 1986. We've completed at this point tens of thousands of reserve studies for all different types of properties all around the world. We've got offices from coast to coast. The majority of the work that we do, probably 90+% of our clients, are community associations. So that's going to include all types of condos, HOAs, timeshares, other types of residential properties. But we also have a great deal of experience with other property types, things like office buildings, hotels, resorts, worship facilities, and so on. I always like to point out that our only job as a company is preparing reserve studies. We are not an engineering firm or an accounting firm, but rather a very specialized consulting firm where we focus on doing one thing really well, which is to guide our clients towards a successful financial future. The way we do that is by preparing accurate and reliable reserve studies that help those clients to forecast and budget for major projects. So we feel that if we do our job well and our clients follow the plans that we design for them, then hopefully they're able to reduce the risk of special assessments and bank loans and other types of financial distress. So to close that out, if you want any additional information about our company, please visit reservestudy.com. It's down there in the bottom right of all these slides you're going to see. Or feel free to email me. My email address is wsimons@reservestudy.com, WSIMONS@reservestudy.com. So Jill, maybe if you can post my email address into the chat feature, that would be helpful for anybody who needs that. Okay, so this is a quick overview of what we'll talk about today. Basically, I have 3 sections for you guys. The first section is going to focus mainly on the philosophy or kind of the why about reserves. Why is it not okay for associations to just pass special assessments or go out and get loans every time they want to take on a big project? The next middle section there is a really important building block that will help us understand some of the metrics involved in reserve studies, which is a topic called percent funded. And then once we've covered that, we'll move into the heart of the course, probably the whole second half of the course today, which is a really detailed overview of the 2 different reserve funding methodologies. There you go. There's the title of the course. Those are called the pooled method and the straight line method. So we'll get into all kinds of detail there. But first, let's ask this basic question. Okay, so why have reserves at all? And to put this in perspective, I always like to pose this hypothetical question. So just think to yourself for a moment, what are reserves for? Why do associations collect reserves? And specifically, are reserves for the here and now, or are they for the future? So just take a minute to ponder that for a second. If we were live in a room, I'd ask you to raise your hands, but we'll just let everyone think for a second. I'm going to go ahead and give you the answer. most of the time people would raise more hands for the future. But it's a critical point to make that I want to really drive home right off the bat here, which is that reserve funding is for the here and now. We think it's a misunderstanding to characterize reserve funding as saving up for a future project. And the reason why that's not a great approach is that there's oftentimes a very good chance that the current owners who live in an association won't be living there by the time some future project takes place. So if you think of it from their perspective, maybe it makes sense that they shouldn't be funding reserves towards a future project that they won't be around to benefit from. But if we think of this in a different way, right, if you think of reserve funding as paying a current bill of deterioration, basically offsetting the deterioration that is happening today in the current fiscal year, I think that's the more appropriate way to think of it. It's like this pay-as-you-go model, right? So just as a quick example, let's say that I were to buy a unit in a brand new condo building, and let's say the roof on the building has a 20-year lifespan. Well, if I live there for the first 15 years of that building's existence, that means I'll enjoy 15 years of use and value and benefit out of that roof, not to mention all the other building elements, the mechanical systems, the amenities, and so on. Now, let's say I'm going to sell my unit after those first 15 years, and the incoming buyer who's going to purchase it from me, they're going to live there for the next 15 years. But remember the timeline, only 5 years after they buy the unit from me, the roof is likely to need to be replaced. Now, if I had not been charged accordingly, if I had not been contributing to reserves during the time I lived there, then the new buyer will get stuck with the full cost of the replacement of the roof, right? Now, even though they've only lived there for 5 years or 25% of the roof's life, if my budgets that I were paying into did not fund for that roof replacement, then the new person pays for the full 20 years worth of the cost, whether that's in the form of reserves or a special assessment. So they're really paying their share of the cost of that project, but also my share, even though by then I've moved away. So kind of begs the question, well, so what? Well, if you're the second buyer and you are deciding between associations to buy into, and you're looking at my condo versus another one, the fact that my association doesn't have a healthy, well-funded reserve account means that that potential buyer, that new buyer, is going to be exposed to more cost and a higher chance of a special assessment to essentially make up for all those years that I wasn't being charged for my fair share. And to the extent that they realize that, that will have a downward pressure on property value, which we're going to talk about a little bit more. But let's just cover some groundwork here in our business. We like to talk about these 4 reserve rules. The first of which is that the expenses are inevitable. Okay, there's no getting around the fact that air conditioning systems need to be replaced, elevators need to be modernized, roads need to be repaved, and so on. Number 2, the board is always responsible. Okay, they're the ones who are entrusted with managing the community association on behalf of all the owners. Third, when the projects get delayed, they tend to get more expensive. And we see this all the time, especially in the case of things like roofs or concrete restoration or other parts of a building exterior. And then lastly, I think most importantly, the homeowners in the community always get stuck paying the bill. Okay, there's no Uncle Sam, there's no government bailout that's coming for community associations that have not been paying attention to reserves. Okay, just like there are 4 rules for reserve planning, there are 4 options for how to pay those reserve expenses. The first and best option, of course, is to have a healthy reserve fund. The second best option is to pass special assessments when projects come along. I always make the lame joke here that it's a bad situation when the second best option has that skull and crossbones warning attached to it. But if you've ever lived or managed a community association that has recurring special assessments, I think you know what I mean, right? It's a toxic thing for communities to go through. That's how boards get voted out and management companies get fired. I mean, it's oftentimes as a result of the turmoil that comes with a special assessment. The next best option then would be to take out a loan or a line of credit. So if you're wondering why I have that ranked after a special assessment, that's because the cost of the project will be greater due to the financing involved, the interest. And then what happens if you don't do any of those 3, right? So there is, that school of thought that we can just choose none of the above, well, in that case, then your property starts to fall apart, right? You lose your curb appeal. People don't want to live there anymore, and in turn, you suffer from a decline in property value. So, again, one way or another, it's all coming out of the pockets of the current owners. Here's some of the specific benefits of having a good reserve fund. First and foremost, you shouldn't have any surprises, or at least a lower chance of getting caught by surprise when these things come along. If you're funding your reserves and you're paying attention, then that means you're tracking the life expectancies of your components, which gives you the option to plan ahead and to prepare for when something needs to be replaced rather than reacting and getting caught by surprise when something fails, right? So, again, when you're planning ahead, that gives you the chance to shop around, right? To talk to different providers. You'll have time on your side, which gives you the ability to get more bids, work with a consultant, draw up a really specific scope of work. You can do things like talk to a painting company and find out, is there a good time of year when we want to have our buildings painted? Do you guys have a slow season where the price might be a little better? On the other hand, if you're calling out to those contractors because it's an emergency and you're reacting to something like, a cooling tower that just broke down on the 4th of July, well, then it's no surprise you'll pay a higher cost for the project because it's an emergency, right? You really, you don't have a way out of that. The bottom point here, the one about minimizing exposure, that's mostly relevant to the board members out there. What we mean by that is that if you're proactively taking care of your property, you're doing a better job of upholding your fiduciary duty, which will give you better protection against any complaints or possible lawsuits that might come from the owners. And then the last part here, kind of closing out the circle, is that if you're doing all of those things, that naturally tends to increase your property values. Communities that are doing a good job of reserve funding, that tends to show. They have better curb appeal. They have more up-to-date technology. They have more modern amenities than the ones that don't. And we think that all of that contributes to a better ownership experience for the people who live there. And again, keeping in mind the mindset of a potential buyer, right? And every association out there should be putting its best foot forward and trying to attract those new generations of owners. Of course, all the opposites are true. If you don't have a healthy reserve fund, that means you're probably more exposed to surprises, which can lead to higher expenses, more liability, and kind of in this vicious cycle, declining property values. And what we've seen is that when associations kind of fall into this pattern, it becomes more and more difficult to break out of it the longer time goes on. Okay, so that was pretty short and sweet. I'm going to dive now into the second portion. We're going to talk about percent funded. As I said at the top, this is one of the most important concepts for us to understand because percent funded is, to our knowledge, the only reliably consistent way to measure the strength of an association's reserve account at any point in time. Okay, so we'll just talk about this in the beginning as a snapshot in time of financial strength. The reason for that is that it helps to evaluate how well the association is doing in the present day, even though many of the projects that it's funding for may not be coming due for many years. Okay, fundamentally, percent funded is a way to measure risk. And what we mean specifically there is the risk of financial problems, such as special assessments and bank loans. The last point on this slide is that percent funded is not fixed. That will fluctuate in time based on cash flow. Okay, so if you're contributing to your reserves in a healthy way, hopefully we see an improvement, an increase in percent funded over time, which again means that that association is now becoming better prepared to pay for its major components. So conceptually, one of the best ways that I've found to explain percent funded is using this analogy of a credit score. Okay, as individuals, we've all had our credit reports pulled. We all know generally what your score is going to be. To an outside party like a bank or a credit card company, your credit score is an indicator of what kind of risk you are, right? So in the same way, if you think of the reserve study itself like a credit report, but you have to distill it down, you have to boil it down to one key result, then we think that should be percent funded. We measure it on a 0 to 100% scale, which means that we consider anything between 0 and 30% funded to be a weak position. In that range, associations will have a higher likelihood of special assessments and the other types of problems we've been speaking about. Once you get above 30% funded, normally that means you're more in a kind of a fair or moderate range where the risk is a little more manageable. But where you really want to be is above 70% funded. That's where we've statistically seen that there's the lowest likelihood of those special assessments coming your way. Okay, so we've kind of talked about this conceptually. Now I'm going to go through the process of how percent funded is actually calculated. It's a fairly straightforward idea. All you're really doing here is looking at how much money an association has at some point in time, and then comparing that amount against how much money it theoretically should have at the same point in time. We're just going to turn that into a percentage, and then we can use that for decision making. So the first part, how much money do you have? That's pretty straightforward. When we're doing a reserve study for a client, we're looking at their current financial statements and then trying to look ahead to the start of the next fiscal year in order to find out how much money they will have at the beginning of that year. Second part, a little more complicated, is to compare that amount against how much money they should have at that point. And this concept of how much they should have, that is a figure that we call the fully funded balance. Okay. So again, the fully funded balance is crucial to understand, but it's a theoretical number. The way I like to put this concept in perspective is just to pose a question, right? So if I were to tell you that some association out there has $50,000 in reserves, but you don't know anything else about the property, what do you really know? That there's no way to put that in context, right? And I hear this sort of thing all the time from board members, right? They'll say to me, our association's in great shape. We have, $900,000 in our reserve account. But then I'll point out to them, yeah, that's a ton of money. It sure sounds like a lot, but we don't know if that's adequate unless we have something else to compare it against, right? We have to put that in perspective. So, of course, that depends on what type of property we're talking about. So if this was a little 2-story building with no amenities and just a small parking lot, 50 grand in the bank may be plenty of money for them. But if we're talking about a luxury high-rise condo, a lot of you managers know out there that $50,000 is a drop in the bucket, right? That can be gone in one payment towards one project. So it wouldn't do them much good at all. Okay. So again, we're just trying to start big and then work down into the details here. I want to take this one step further and talk about how do we calculate the fully funded balance? Even though it's a theoretical number, we can calculate a dollar amount here. It's a pretty simple idea. What we're going to do is look at how old any given component is, any part of the property. How old is that compared to its overall lifespan? That'll give us a fraction. We then take that fraction and multiply that by the current estimated cost of the component. Now that tells us how much money we theoretically should have today for its eventual replacement. Now, when we do a reserve study, it doesn't matter if the association has 4 components on the list or hundreds. The idea is that we're going to calculate the fully funded balance for each one and then add all those numbers together. And that will give us the fully funded balance for the entire association. Once we've done that, now then we have something we can look at their balance sheet, look at their actual cash on hand, and make a judgment call as to how they're doing, whether they have enough. All right, so we'll just talk through this example together. For the moment, let's all pretend that we're on the board or we're managing this made up property. We'll call the Seaview condominiums, and our task is to calculate percent funded at the start of their next fiscal year. So now that we've talked through the process, the first thing you have to do is get a determination on the starting balance for that year. So let's say we've reviewed our financial statements, we've analyzed the projected spending for the rest of this year. We know how much money we're going to contribute to reserves by looking at our current budget. And after we've done the math, we assume that we have a starting point of $60,000 going into next year. Of course, the next thing we're going to do is calculate the fully funded balance for each of their components. And for the sake of this example, we're just going to limit it to 3 things, starting with the roof. Let's say the roof is 10 years old with an overall useful life of 20 years. And let's give it a replacement cost estimate of 80 grand. Okay. Now keep in mind that the fully funded balance for the roof is only the proportion of the cost that we need to have on hand today. So since it's halfway through its life, we only really need to have half of the replacement cost saved up today because we know we have another 10 years to collect the difference, okay? So in this case, we'll take 10 over 20 and then multiply that by the $80,000 estimate, which tells us that the theoretical fully funded balance for the roof as of right now is only $40,000, right? It's halfway through its life. So this association should have half of the replacement cost in the bank in a perfect world, right? Theoretically, they should have half. Next example here, let's say we're going to do this for the gym equipment. Now, if the equipment is 5 years old and overall its life expectancy is about 15 years and the replacement cost is 30,000, then we would take 5 divided by 15, multiply that by the 30,000, and we then figure out that the fully funded balance for the gym equipment is 10 grand. So again, third of the way through its life, so you only need to have a third of its replacement cost saved today. All right, last example here, we're going to say that we painted the hallways of the building 2 years ago, and the life cycle on that is every 8 years. And if we assume a $100,000 cost for that, we take 2 divided by 8, so it's 1/4 or 25% of the way through the life expectancy. At a cost estimate of 100 grand, we can now calculate that the fully funded balance for painting should be 25,000. All right. So now that we know the starting reserve balance and we know that we've calculated the individual fully funded balances for each item on the schedule, we can now come up with percent funded for the entire association. Okay, we'll just look at the numbers we calculated, we add them together, we take the 40 grand for the roof, 10 grand for the gym equipment, and 25 grand for painting, add those together, and we have a theoretical fully funded balance of $75,000. Okay, so now that we know that, we know what they should have, we're able to look at the cash that they do have, 60,000, and make a determination that this association is 80% funded, 60 divided by 75. Okay, we're almost done with this section here, but before we move on, I want to just talk about how we draw financial conclusions about associations based on that level of percent funded. Okay, so what you're looking at here on this chart, this is the result of a huge internal analysis that we completed several years ago, looking at a data set of actually thousands of associations we worked with and measuring for 2 variables. Okay, so the first one was what was their percent funded level? And then secondly, when we did a study for that property, did we need to include any special assessments right away in their funding plan? Now the results here are pretty obvious and pretty much what we would have expected. Basically, the closer an association is to 0% funded, the higher the frequency that they needed immediate special assessments as part of their funding plan, which only makes sense, right? If they have very little cash in the bank and they have some projects that are coming up soon, it's very likely that they need immediate injections of cash in the form of a special assessment. Okay, another internal study we did a couple years later. This time we were looking at percent funded and wanting to know, is there a measurable correlation between percent funded and property value? Okay, so this time what we did was we looked at a data set that was all concentrated in one metropolitan area. In particular, it was in Southern California, very competitive real estate market. And we looked at a data set of properties that were all as similar as they could be in terms of their size and their age and the amenities at the property and so on. Okay, we then measured the market value of the units, of the homes in those communities to see, okay, does it make a difference when the associations themselves were in a better financial position? And the results were pretty interesting. So the first thing we did was we set a baseline as defined by those associations that were in a weak position, right? 0 to 30% funded. So then we looked at, what happens to property values when communities are in a fair position between 30 and 70% funded. So again, all else being as equal as possible, what we found was that the communities that were in a fair position had dollars per square foot market values that tended to be about 8% higher than those that were in the weaker associations. And then looking even further, what happens when they're in a strong position above 70%? Well, in that case, it was almost a 13% gain over their counterparts that were in a weak position. Now, intuitively, you can kind of see how that would be the case, right? The associations that have money in the bank tend to have better curb appeal. They're in better physical condition, which in turn translates into them being more attractive to potential buyers. They're willing to pay more to buy into that community. So if we go all the way back to our initial question that we started with, well, why have reserves at all? One answer is that that can actually translate back to you in the form of higher property values. So very interesting stuff. All right, we're about halfway through now, and this is where we're going to start talking about this last, probably most important part of this class, maybe the reason some of you attended today, but we're going to talk about the two ways that associations can calculate reserve funding. First, I'm going to go over the straight line method. The other term for this is called the component method. And the reason for that is that all components, meaning each line item on a schedule, roof, painting, elevators, swimming pools, each one of those represents a component. And each of those is treated separately from a funding standpoint. Personally, I think of this being the old-fashioned way. More and more communities are switching over to the pooled method, which we're going to talk about in a moment. But part of the reason it's the old-fashioned way is because prior to 2002, at least in Florida, this was the only method. It was not allowed to, associations were not allowed to use the pooled method until after 2002, which, almost 20 years ago now. I characterize this method as being simple in theory, but can get really screwy and really sideways when you actually try to put it into practice. But we'll first just kind of talk through it conceptually. If you want to understand this method, I think it's really helpful to use this analogy that we're going to look at each category of reserve components as being handled in a separate bucket of cash, okay? So for this example, we'll talk about these 5 buckets here: roofs, elevator, painting, mechanical, and pavement. When you're using this method, each year when you're preparing the budget, you determine the amount of reserve funding you need for each one using a pretty straightforward calculation. Basically, you look at the cost of a component, you subtract out any existing funds that have already been saved, and then you divide the remaining difference by the remaining useful life of that component. And whatever that calculation comes up with, that is the amount required to fully fund that component in the following year's budget. Now, I put quotation marks on fully fund for a specific reason, which we're going to get into, but this method is pretty clear, pretty straightforward. There's really no room for interpretation there. That is what fully funding means when you're using the straight line method. So we'll use this first one, the roof reserve, as our first example. Now, if you understand that the total volume of the bucket represents the total cost to replace that roof, we can then look at the existing cash, the existing reserve money, as being the contents of the bucket that's already there. And the empty portion, that's what I'm going to refer to as the unfunded balance. That's the difference between the total cost and the cash that you've already saved, okay? Now, if we put real numbers to it, let's say that the cost of replacing the roof is 200 grand and we've already got 140,000 in our roof reserve. That means we have an unfunded balance of $60,000. Okay, that's the difference we need to close. So in order for me to determine how much I need to be funding that roof reserve bucket going forward, I'm going to take my $200,000 costs and I'm going to subtract my 140,000 in existing reserves, and I'm going to divide that difference over the remaining life of the roof. So let's say we've determined that remaining life is 3 years. I'll take 200,000, subtract 140,000, which gives me 60,000. Right? 60,000 then divided by 3 means that I need to put 20 grand a year into my roof reserves for the next 3 years in order to fully fund it, which makes sense, right? By then I will have accumulated the full $200,000 replacement cost. I replace the roof and we basically start over again. Now, in order to do the budget each year, you have to go through that process for each of those reserve categories, each of those buckets. And as this plays out over time, you can eventually end up with a variety of different funding positions in each one, right? So depending on how accurate your estimates were for life expectancies and costs of all these these components, some accounts may be really well funded while others are not at all. So I would characterize this as a very inefficient distribution of the sum of this association's total cash, right? Of all the reserves together, it's not proportionally spread out by need or by percentage amongst these categories. So, you know, you can have a situation where money is locked up in one account when it would be really advantageous to move it over for some other project that's maybe a higher priority. Obviously, that makes things start to get real complicated. Some of the problems that we identify with this method, first and foremost, it's very often the case that there's been no prior reserve fund established for something really important, such as concrete restoration. Or another one is that the funds might be too broadly defined. For example, we'll sometimes see that a property has one large combined account that's just labeled as mechanical funds. And that's supposed to try and capture everything from their security cameras to the fire alarms to cooling towers. The problem is that all of those have very different life expectancies and different replacement costs. And if they're just kind of blindly combined into one big category, then you have to start to do some really complicated math to figure out, okay, well, how much of the funding going into this mechanical bucket is going to each of these things. So it starts to get real messy. The second point here from a management standpoint, and I'm sure some of you guys can relate to this component method can be much more of a headache. Now, why is that? Well, uh, under this method, the statutes require that the owners would have to vote to approve the moving of funds from one place to another. So for example, moving money from your elevator reserves to your parking lot reserves. We all know that getting a quorum, passing a vote for anything in a community is usually very difficult, but especially so when it comes to this type of vote to move money around. You know, we've seen for many years that residents can be very skeptical of their boards. They're hesitant to approve that unless they fully understand the need and understand the situation. Oftentimes that means that the board, the manager have to call special meetings, you know, send tons of emails and letters, get their attorneys involved. Just becomes a kind of administrative hassle. Um, and then lastly, probably the most significant problem with this method is that because it's more conservative, because associations are not making the most efficient use of the sum of all their available cash, this method ends up costing the owners in the association more money each year to fully fund it, to properly fund the reserve account. What's interesting is at the end of each year as a company, we look back at all the studies we've produced and we will look at our funding recommendations for those clients that are currently using this method. So when we do the studies, we're going to give it to them this way, but also we'll show them, okay, if you pool your reserves, this is what the difference would be. And for comparison, last year, you know, out of hundreds of studies we did where we included both methods, what we found was that the average difference was about 200%. So, you know, let me say that again. On average, those clients that are using the straight line method would require triple the amount of funding from the owners if they stay in that method, as opposed to them pooling their reserves together. And, you know, obviously, given that pretty much every association out there is constantly trying to cut costs, lower their assessments, make it more affordable for the owners, this is one of the easiest ways to do that. We teach them about pooled reserves, and you know, more and more of them are making that switch and never looking back. So, you know, again, we'll talk about this. The good news, of course, is there is a better option, the pooled method. This is also known as the cash flow method. For background, again, this has only been approved in Florida since 2002, but because ours is a national company, I can tell you that outside of Florida, this is essentially universal. We have 12 offices throughout the United States. Our Florida office is the only one that ever has clients still using the straight line method. So one way to distinguish this one is that, you know, in contrast, I think this one is maybe a little bit more complex in theory, but once you get the hang of it, once you're accustomed to it, this can actually be much easier to use for budgeting. One of the most common questions that I get when we talk about these two is, you know, if we have the straight line method now, but we're interested in switching to the pooled method, well, how would we do that? So we added this slide to kind of talk you through that. First and foremost, it's important to point out A board can create a new pooled reserve account all by itself. Okay, so for example, the board can say that as of this upcoming 2022 fiscal year, all of our new incoming reserve money will be going into this pool of funds. Okay, that itself does not require the owners to approve it. However, if the board wants to move money from their existing straight line accounts into the new pooled account, that requires the owners to vote and approve it. It's basically the same idea as moving funds from one reserve account to another. It's considered a non-scheduled use of those reserve funds. So the same voting process is required as if you were moving money from, let's say, painting reserves to elevator reserves. Now, the good news here is that that's a one-time process. You don't have to renew that vote every year when you adopt the budget. So that is good. It's a one and done thing that does not need to be refreshed. If your association is considering that, I always highly recommend that you work with your association CPA, maybe your attorney, just to make sure you're going through that process correctly. And of course, if you have a reserve study provider, then I'm sure they'll be involved with that as well. But more and more communities are quite happily doing that each year. So kind of going back to this pooled method explanation, continuing with that same bucket analogy we used before, what I now want you to do is imagine you take all those separate buckets of money and dump them into one big bathtub. Okay, now when you do that, you essentially remove the labels from any specific categories of reserve funding. Now, all of your reserves, the entire pool of funds, is collectively available for any component that's on the list. So in other words, there's no such thing anymore as a roof reserve dollar or a painting reserve dollar or elevator reserve money. It is all just, broadly defined as reserve cash that can be spent a lot more effectively and efficiently. So we're going to talk through the process of how you develop your budget using this pooled method, but the first step is exactly the same as when you're using straight line, right? I just want to point out the foundation of any good reserve plan using either methodology is that you have to have an accurate list of components. It really doesn't matter which one you're using if your underlying assumptions are not reliable. So once you've got that list of components and all of the life expectancies and costs that go with them, now you can look forward and start to design a timeline of future expenses. Okay, so it might look something like this. Most reserve studies will include at least a 20, if not a 30-year forecast. And what we do there is we show the approximate amounts that are going to be spent in each year, which, as you can see, can fluctuate pretty wildly. Some years there's no reserve spending at all. Other years there can be 6 or 7 figures worth of money that you spend. And the challenge is, once you know what those future expenditures look like, now you have to determine, well, how much money needs to go into my reserve account in order to meet those expenses. I'm going to walk you through the process. It's fairly straightforward, but of course, the first thing to do, again, is determine the sum total of reserve funds at the start of the fiscal year. What are you bringing to the table at the start of this process? How much cash do you have? The next thing we do is we start testing some assumptions. How much money will you contribute to that account? Now, notice this can also include interest earnings at this point. So here's already a big advantage over the straight line method, which doesn't actually allow us to factor in future interest earnings when making these projections. So now that we're factoring in what the bank can pay us, that helps reduce the amount you have to collect from the owners. From there, you go back to your forecast of expenses and you see what are your estimated costs that are coming up on the schedule for that first year. You're going to do the math where you take your starting position, you add your reserve income, your contributions plus interest earnings, you subtract your reserve expenses for any work you're going to do in that year, and that will leave you with an account balance that will start you off for the next fiscal year. Now, when you look at that next year, obviously the first thing you have to do is make sure you still have some money in the bank. If not, then you'll have to go back to the drawing board and use a higher contribution rate, because one of the core principles here is that you cannot design a plan that will ever take you below zero. We'll talk about that in just a few minutes, but the beauty of doing this process using an Excel spreadsheet or a third-party software is that you can model the same types of projections for many years at a time, right? You take a few seconds, you set up some formulas, and then you see the recurring cash in and cash out that plays out over time. That's, again, why this is called the cash flow method. Um, and when you do that, the most important thing is that you're making sure that you keep your reserve account balance at a safe level. Um, which leads me to a really important point here. There are differences of opinion over what is considered to be a safe level. We're going to break these down. Basically, there are three possible funding objectives, which are called baseline funding, full funding, and threshold funding. I'm going to break these down, but again, these are the options on the table that you are going to consider when you're designing your pooled funding plan and figuring out, well, how much money do I need to leave in reserves in any given fiscal year? So the first objective I'm going to talk about is most commonly known as baseline funding. I'm not going to beat around the bush here. This is the riskiest option on the table. Now in Florida, this is perfectly legal to do, but for most communities, it's not a great idea. Basically, the objective here is that you're figuring out what is the bare minimum amount of money that needs to go into reserves to keep that account balance above zero throughout the forecasted timeline. Now, this is where I'm kind of breaking new ground with this class. I want to make this part really clear. When I talk to managers and to accountants out there, I feel that there's this, this disconnect in the terminology. The problem is that when I talk to most people in Florida and we ask what their understanding of the term fully funding means when it comes to a pooled reserve fund, what they will then describe is what I'm now telling you is called baseline funding. Okay, it is the minimum that's required by law unless you get a vote of the owners to approve something less than that. So usually the conversation at budget time is, boards and CAMs are asking, what's the amount of money that we need to put into the budget so that we don't have to vote to approve less than that, okay? And the law says that that amount, that number that needs to be put in the budget to avoid a vote is whatever amount would be required to keep a positive cash balance in reserves over time, right? So as you model out your cash in and cash out over the next couple of decades, as long as you keep that number above zero, that's acceptable. This is the actual language that's published in the legislation with respect to pooled funding. Basically says that your contribution rate needs to be enough so that over time your cash inflows are greater than your cash outflows, but that's it. There's no other requirements to go along with it. Now, if you take the time to actually read the legislation, the term fully funding is not used anywhere with respect to the pooled method. The closest thing I could find is the term sufficient funds. And in fact, the DBPR has, excuse me, has a manual that they publish, which is used by managers and board members and explains how to design a pooled funding calculation. So in the example that they use in that manual, the association they're using as an example gets to a point where they only have $4 in their reserve account and the state labels that as sufficient. But I think everybody out there would understand and agree that, there's probably never a good circumstance where an association has only $4 in their reserve account and that is a healthy place to be. Obviously, if you're just doing the bare minimum and that you're setting that as your objective, it only takes one problem to screw that plan up, which could be some project happening a little bit earlier than you thought or costing a little bit more than you thought. The point is that if you're trying to thread the needle that closely, there's just no margin for error. And so in those cases, the chances that special assessments or loans will be required become very, very high, which obviously is, again, something that we're trying to avoid. That's one of the main reasons why you should be funding reserves. So I'll look at this table with you guys. This is a real world example. This is a job we just finished within the last week, where we presented a baseline funding calculation. If you look at the top left corner here, the first column on the left shows all 30 years of the financial plan. Moving from left to right, you start to see different numbers corresponding to each fiscal year. You've got your starting reserve balance, your fully funded balance as of that year, which translates into percent funded. We then measure that in terms of risk. Is this a low, medium, or high risk position to be at that level? We then, excuse me, getting ahead of ourselves here. The next column here is the projected reserve contributions for that fiscal year, right? So we're testing out a number here that keeps cash above zero, but only by a little bit. If there's any need for loans or special assessments, that would be shown here in this column. Um, and basically this whole right hand side is cash in and then cash out, farthest right column being expenses. So if we just look at this first fiscal year, you've got a starting reserve balance of about 1.1 million, which we then compare against the theoretical fully funded balance at the same time, which is a little over 1.2, which means this association's in good shape. They're starting at about 89.9% funded. So from there, the idea is to figure out how much of a contribution rate is required to at least meet these expenses, but also keep the cash balance above zero. Okay, so even though these guys are starting from a strong position, they've got a lot of money to spend. They have a lot of expenses coming up soon. And if we just go with this baseline contribution rate, even though their cash balance stays positive, at some point they drop down to only having a few $100 in the bank, which if you look at that fully funded balance at the same time, it's close to 400,000. So they become very, very poorly funded. Again, the state would say this is sufficient and the owners do not have to vote to approve this plan. It would only come to a vote if they wanted to do less than that. But a board proposing this plan, I don't think is doing their community any favors here. Okay, we've talked about the minimum requirements. Now I'm going to switch to the other end of the spectrum, which is the most conservative option on the table, which is called full funding or fully funding of reserves. Now, I'm going to be careful here. When I use this term full funding in the context of a pooled reserve account, I'm using a definition that comes from National Reserve Study Standards. Now, as we talked about on the last couple slides, most people in Florida, when they think of fully funding, what they're actually understanding is what we in the industry call baseline funding. There's a bit of interesting history on this. CAI actually adopted the National Reserve Study Standards in 1998, 4 years prior to when pooled funding became allowable in Florida. And I wish I could have been in the room at that time to point out that, look, there is existing terminology here that we can use. But ever since then, when people talk about full funding, they quite often mean baseline. But in reality, the real definition of this term, full funding, means you're setting an objective to attain and maintain reserves at or near 100% funded. That's why we include that segment in this class to understand that rationale there, that concept. So going back to our example, this is again for that same association. If we use the same numbers, but instead now the objective is to attain and maintain this position of becoming 100% funded, you see how that plays out. Really important to understand, in either case, the expenses are the same. It's just what are we considering to be a safe level in reserves over time that's going to reduce the risk of financial distress. And I thought it would be relevant to point out, well, what is the difference here? This is a chart that kind of represents both options. So on this chart, we're looking at percent funded here on the left vertical axis, and on the bottom, we've got time going from 2022 out to 2051. The different colored dots along the way are measuring percent funded based on each plan. So notice they all start from the same place, about 90% funded. But if you look at the green dots here, this sequence here, you see that percent funded stays strong the entire time, eventually gradually reaching 100%. The orange dots here represent that baseline plan, that minimum that's required by law. Now, if you notice, that plan actually looks okay for the first 10 years or so, but then it falls completely off a cliff. We allow it to get as close to zero as possible without going below, but then it never really recovers back up to a strong level again. So what's the difference between these? Okay, the baseline plan in this example required $70,500 in contributions. The full funding plan required $94,500. That difference is about 34%. Now, when we look at this in a grand scale, that's actually a much larger difference than we normally see between these two. In most cases, the difference between baseline funding and full funding is closer to like 15 or 20% difference. But put it this way, even at 34% difference, in this example, that amounted to $15 per unit per month. Okay, so think about that for a second. Less than $1 a day per owner meant the difference between doing the riskiest possible thing and the safest, most responsible thing when it comes to reserves. Now there is one other series here, the purple dots. We showed the client in this case, this is what happens if you just keep doing what you're doing. I think they had been contributing something like 50,000, but it's clearly illustrated that that will drive you into the ground at some point. So you're going to have to increase your reserve funding no matter what. But while you're at it, let's do that in the most responsible way possible that will result in the lowest risk for you going forward. Okay, I'm not going to spend a lot of time on this last one. It's pretty simple to understand. Basically, the third option on the table is called threshold funding, which is any objective between baseline and full. Basically, you pick a target and then you design your funding plan accordingly. So you could say, instead of becoming 100% funded, we just want to become 70%. Or another way to do it is we want to make sure that we never drop below $1 million in our pooled reserves. One of the problems with this subjective is that this is, with this objective, is that it's more open to interpretation, right? So if a board in one fiscal year decides they want the threshold to be 50% funded, but then the next year you've got a new board in place and they said, no, 20% is sufficient, that has a wild swing on how much money needs to go into the plan. So when we do these for a client, it's usually kind of a custom scenario. But as we talked about on the last slide, usually they'd be better off just fully funding and going for 100% anyways, because the difference is really not that much more. Okay, I know we've only got a few minutes left. This will be our grand finale today. I want to talk to you about one of the most frustrating parts of being a reserve study provider in the state of Florida these days. On the screen in front of you, I have a paragraph that I copied from the Florida Administrative Code, which is basically the state's official interpretations of what's written in statute. So in the section of the code where they talk about pooled reserve funding, they have this one sentence at the end, way down here, which talks about the funding plan not allowing for balloon payments. Now, I'm sure that when they wrote this, they had good intentions. I think that the inspiration behind this was to prevent boards from intentionally kicking the can down the road. But the term they used in this context, balloon payment, has a very different understanding in most accounting contexts. The general understanding of that term, balloon payment, typically describes a situation like a mortgage, where for the majority of a mortgage, the borrower pays a certain amount of money each month, and then at the very end of the term, they make one single final payment, which is much larger than any of the payments that came before it. And if you think of that in association terms, it makes sense why that's not fair. Basically, they don't want an association to do some minimal amount of funding each year for many years, and then at some point in the future, plug in a much higher level in a particular year when some big project is scheduled to occur. So for example, let's say you've got a townhome community that needs to replace tile roofs, right? That will typically be the largest expense in their reserve schedule by a huge factor. And if we assume that that project is scheduled for 10 years from now, the board that's sitting in there today might be tempted to say, hey, look, we can get away with doing a lower level of funding for the next 9 years if we assume that in year 10, we can just plug in a really big number that will cover the cost of the roofs that year. So what they're doing in that scenario is they're committing that future group of owners who will be there 10 years from now to basically pick up the tab. They would be the ones that have to pay that balloon payment. So that would allow the owners in the present day for years 1 through 9 to get away with doing a lower amount of funding. And to me, that's not fair. I understand why they would want to put a stop to that. So you may be thinking, well, so what? Well, here's the problem. Over the last several years, it's come to our attention when we talk with associations and with their accountants doing their audits that the term balloon payment in this context has been interpreted to mean any increase whatsoever in the reserve funding amount. So for example, I might tell a client that, this year you need to contribute $100,000 to reserves. That's based on the analysis using your current replacement costs for these things and factoring in their remaining life expectancies. But next year, we can reasonably assume that costs are going to go up due to inflation, right? And to help keep up with that assumption for inflation, next year you should plan to contribute something like $103,000 in year 2. Then in year 3, costs are likely to keep climbing. You should contribute a little bit more and a little bit more the year after that. The problem that we've run into is that the state is now saying, no, you can't have any increases in your contribution rate. That would be a balloon payment. Now our response has been, well, wait a minute, you're allowing us and maybe even encouraging us to use some assumption for inflation in our studies. That means the costs of the components that this association is budgeting for will be increasing over time. We agree on that, but you're telling us that we're not allowed to assume any increase in the contribution rate. Now, this is a really major problem because if we all agree that inflation is real and the costs will go up over time, but I'm not allowed to make the same assumption on the other side of the model that the contributions to reserves can also increase to meet those rising costs, well, now it suddenly gets a lot more expensive to make the plan work, right? You're allowing the assumption that the expenses will go up, but I can't increase my income. I still need to create a plan that meets whatever criteria I'm setting forth, whether that's baseline or full funding. So in order to cover those rising expenses, all else being equal, I'd be forced to use a higher contribution rate, right? In the near term of the funding plan, in order to set us on a trajectory that covers our bases down the road, we need to contribute a higher amount of money. Now that's unfair, of course, to the current owners. In that scenario, they're paying more than they should for reserves. Uh, so when we point that out, the state says, well, then just take out inflation. Don't assume that costs will go up and then things should balance out. And that's the part that really kind of gets under my skin, right? Because we're in the business of delivering financial recommendations to our clients. And now we're being told that one of the key underlying factors when making these forecasts should just be removed. It doesn't feel right. No one in their right mind assumes that something that costs 10 grand today will still cost 10 grand 15 years from now. But in order to make the plan work, that's sometimes the only logical conclusion. We take out inflation, that makes the funding amount become more appropriate, and there we are. So what does that mean for managers and board members? And we're about to wrap this up. This is where you guys come in. The message that we all need to reinforce to associations is that budgeting for reserves is an annual exercise. In other words, they cannot have a reserve study done in 1 year and then expect that they can use that same document for 3, 4, 5 years in a row, especially if there's no inflation in the assumptions. Every association needs to produce a new reserve schedule each year that will always be based on the market pricing for components at that time. That's the only way you can realistically keep on top of these things. So in the same way that they have an annual audit done, they should have an annual reserve analysis done. That's just the bottom line. Given that these are restrictions that we have to work with, it makes sense that any forecast beyond year one of a plan will be unreliable. So the good news is that there are low cost options for keeping these things updated. There's various types of software out there that board members can use at budget time to make sure they're using real numbers. And obviously this could all change. Surely our hope is that one day they get rid of this whole balloon payment fiasco and allow us to make realistic assumptions again. But until then, it's just critical to keep in mind that a reserve study has an expiration date and it's only as good as the data that goes into it. So bottom line, you guys out there, don't allow your associations to make decisions based on unrealistic information. Keep your schedules up to date, work with your professionals, and that's the path to success. So I'm going to wrap this up. We'll go to Q&A. I appreciate you guys staying on. I know we had to have some people depart. But if I've done my job, hopefully we all agree that reserves are incredibly important. When you're designing in your annual budgets, think hard, think wisely about which method you're going to use to do so. And then once you've chosen that method, be smart about what your long-term objectives should be. The goals should never just be to keep the dues low and keep your members happy, right? As leaders in the industry, whether you're a reserve study provider, a property manager, a board member, it's all of our responsibility to educate the people we represent and to help them make good decisions. Okay. All right. So thank you very much. I will go ahead and turn my camera back on here in just a moment. And now we can open it up for any questions that you guys might have.
Yep, we have 5 questions.
Excellent. All right. Let me, I'll stop sharing so we can make this a little bit bigger. Okay. Jill, you want to just start rapid firing those questions to me?
Sure. How often do you recommend updating a condo's reserve study?
Well, like we just said there at the end, the reserve schedule needs to be updated every single year as part of the budget. Doing a reserve study, meaning hiring a third party, somebody like us, That's discretionary. I mean, the conventional wisdom is maybe every 3 years or so, you should be getting professional guidance, including a fresh inspection of your property um, to make sure everything's kept up to date. So, in states where it is required, usually every 3 years is the interval, but one way or another, that schedule needs to be updated every single year.
Okay. Next question. Rick Clyde. Usually full funding is determined based on the reserve study requirement, isn't it?
Well, that's the crux of the issue. I mean, the minimum required by law is that you keep your cash balance above zero. So whatever the reserve study says, that is, superseded by the law or by the governing documents of the community. So if a community has a study done that recommends a certain amount of funding, that will be based on a certain set of underlying criteria, which the board or the association may disagree with. So they can come up with their own reserve schedule and model that out accordingly. Um, and so as long as they're keeping their cash balance above zero, that's the minimum requirement. I mean, a lot of people would say that if you've had a professional study done, to ignore its recommendations is probably not a good idea. Um, so yeah, I mean, that's really the issue. When we do a study and other providers do one, sometimes there will be these kind of options on the table. We'll say to you, okay, here is your minimum that's required by law. Here's a, maybe more conservative method that will long-term put your association in a better position.
And next question is from Michael. Um, Funny, I can't pronounce his name. It's very Italian. Gumarelli. Can you discuss borrowing from reserve and paying it back?
Sure. So legally speaking, associations can borrow from reserves. They can really use reserves for any purpose as long as they get the majority approval of the owners. So if you have to pay an insurance deductible or pay a legal fee or use the money for some emergency purpose, you can use that money from reserves. And in fact, you don't technically have to pay it back. Although of course you should. That money was there for a specific reason, and when you take it out of reserves, then you're dooming yourself to a special assessment when those things come along. So very important that you do it. I would definitely get the advice of your attorney to make sure you're doing that properly, and come up with some kind of plan to pay it back as soon as you can, because otherwise you're going to find yourself in a hole for something else.
Okay, and then we have a question from Jason Cintron. Hello, we have several roofs in our community. There are repairs needed in order to bring the roofs up to code. This would be our only expense this repair for roofs, our hope. Could we use our reserves to make those necessary repairs?
Yes, yeah. If you're using reserve money to extend the useful life expectancy of the roofs, then that's an appropriate way to spend the money. It doesn't have to be a full-scale replacement of them. The theory is that if you're buying yourself time by doing these repairs, then it's reasonable to use reserve money for that. Yep.
Um, then from Suzanne Clough, what are the fees associated for the reserve study?
It's a good question. It's a tough one to answer without knowing more about the specifics of the property. I can give you some general numbers. So if a community's never had one done before, then you need to start with a very comprehensive, what's called a full study. On average, that can be, let's say between $3,000 and $6,000. It's a very broad range. It can be less than that. It can be more than that. But I think that's kind of the middle distribution of the bell curve. Let's say that's going to be a typical price point somewhere in there.
And how often do you adjust your reserve funding? From David Zeller.
Well, reserve funding should be adjusted every year along with the budget, right? You have to go through the steps of looking at your current data for life expectancies and costs, looking at your cash that you have in the bank, and then modeling that out for the future. So hopefully there's not wild fluctuations from year to year, but it needs to be refreshed each year based on the changes that may have taken place, right? So if you borrowed from reserves, for example, if you did some big projects which reset the life expectancy on those things, now it's time to reevaluate that. But hopefully it will be fairly consistent from year to year.
This next one, What is the best way to play catch up for a community that has not properly budgeted for reserves and has significant upcoming needs?
It's really only two options on the table. It's either a special assessment, a loan, or a line of credit, or some combination of the two. You know, there's plenty of banks out there. We have a lot of great bankers that are part of the chapter that I'm sure would be happy to speak with you about that. But yeah, if you don't have the luxury of time on your side, if your association is behind and you don't have time to accumulate that money through regular contributions, then it's appropriate to think of a special assessment as making up for lost time. It's the catch up for all the prior years that you should have been doing this properly and it wasn't done. And now we're up against it, folks. We've got work to do, and we're either going to pass the hat and have everybody write us a check, or we're going to go out to a bank and finance it. And then we'll pay it off over the following years in our operating budget. But yeah, those are kind of the only options on the table, unfortunately.
And the next question, how can you adjust the budget at any time you want?
I don't know if I'm the right person to answer that. I guess that's maybe a question for an attorney or a CPA. I mean, the budget needs to be updated each year based on an assumption of income and expenses for the following year. So that doesn't mean you can necessarily revise a existing adopted budget. So if you're thinking that your budget was off for some reason, then it's probably better to just file that away, make sure that the next time you adopt your budget, whatever changes you need to make are done that way. I don't think that makes a lot of sense to retroactively publish a new budget in light of new information. It's better just to roll that forward to the next time.
And the next question is a follow-up question, it looks like, from David Zeller. He had asked, how often can you adjust your reserve funding? And then this next question is, how is that different from the ballooning?
Well, balloon payments mean that when you are looking long-term, right? We only design one budget at a time for one fiscal year at a time. But that budget process includes a forecast for future years. And so when you make the forecast for future years, you're not allowed to assume that your contribution rate can increase. But you're only passing one budget at a time. So even though the contribution rate may be flat for the next 20 or 30 years, you're not locking in that contribution rate. What happens is the following year, hopefully you would take a new accounting of what things cost and what the life expectancies would be, and you can increase your reserve funding number in that second year. But again, from the second year on, then the new number would need to be held flat for all your future forecasting. So yeah, I get that this is a tricky and complicated subject, and it's really frustrating that this interpretation exists right now. But my understanding is that it's going to be codified pretty soon. I believe there's legislation in the works right now that is going to specifically state that your pooled reserve funding forecast must contain level and equal payments in each year of the timeline. So keep a lookout for that. But for right now, that's the interpretation.
And next is it legal for an association of 65 units to not be baseline funded? If so, how is this enforced? And what can a community member who wants the proper reserves do?
Basically, the enforcement of all this comes from complaints, right? So a concerned citizen, so to speak, would have to file a complaint with the DBPR showing that, the budget that's been proposed by my board is not sufficient. And then the DBPR investigates that and will respond accordingly. Either they'll have you publish a new budget. In some cases, they can fine the association. That's meant to be a protective measure for communities. They don't want the wool to be pulled over people's eyes, and they find out when it's too late that the community doesn't have any money. The membership of the association can always vote to do less than what is required. I'd say required in soft quotes there. Members of an association can decide, hey, we don't want to reserve fund at all. Okay, we can just special assess for whatever we need. We can write a check. We accept the risk of that happening. So that's what we want to do. But it's up to the board each year to propose a proper amount of funding so that they can at least make an educated decision about it.
And I think there's one more question in the chat. Um, is it possible to arrange and schedule with you a presentation to the whole board and maybe the membership and what is involved?
Yeah, sure. Send me an email. It's, wsimons@reservestudy.com. The simpler thing might be to just send them a recording to today's session. We do have this recorded. That might be a great first step, but if you wanted something that's a little more customized or tailored to a specific situation, shoot me an email or give me a call. I'm happy to discuss, maybe some more of the particulars with you there, and that goes for everybody here today. We're here to help, so.
And let me just make sure there is nothing else that came in. I think that's it.
Okay, well, hey, Jill, thank you very much. Everybody out there, thank you for attending. Apologies for running a little bit long. It's, as you can see, tough to condense some of this information because it is so detailed and so specific. But if I didn't cover something that you wanted to hear about, or if you have follow-up questions, please give me a call or an email me anytime. We will be sending out all the material from today's class as well. So feel free to rewatch that and share it with whoever you like. So. Thanks again.
And thank you very much, Will. Wonderful
My pleasure.
presentation as usual.
Great. All right. Thanks, everybody. Have a great day.
Bye, everyone.